gears here to leases. When you think about leases, we had a lot of pushback. There was a lot of controversy about this standard. You can't mean we're going to have to put up operating leases on the balance sheet. And I asked a very simple question when I met with CEOs and CFOs. I said, when you sign a contract to lease something, say office building space or equipment, you signed it and you said you were going to make payments for 5 years, 10 years, 20 years. Do you have a legal obligation? And everyone said yes. Well, if you have a legal obligation, where is that on the balance sheet? And what did you get for that legal obligation? Did you get some type of asset? In this case, yes. So once you phrase it in terms of, do you have an asset and an obligation, most people quickly said yes. Then the discussion quickly changed to, now how best to reflect that asset. That's what this standard is about. For years, it was FAS 13 was on the CPA exam in 1978. First time on the exam, I remember because I sat and took the exam November of 78. I remember FAS 13 very well. That was a big change, but the controversy then was, should assets and liabilities be on the balance sheet for operating leases? It took a long time for us to get there. It is there now, and I think that it better reflects it better reflects the economics of the transaction. So when I talk about the quality of standards changing, this is a great example of how the quality of standards have improved, and particularly because investors were already making estimates, and actually in many cases we found were already capitalizing an asset and booking liability and going the next step of figuring out what the interest cost was on that, in effect, obligation. So if investors were doing all the homework to make their best estimates, what this standard does is, in fact, takes that, instead of taking the footnote and multiplying by 6 or 7 or 8 times, which was fairly typical to put up as an asset and liability, we're actually getting a far more, I'm going to hesitate, but I'm going to call it an accurate assessment of what that right is and that obligation, because you're going to get more calculations around what the present value of those cash flows are. And I would argue, as a former analyst, when I start to see those shifts in rights and obligations over time, that's going to suggest maybe shifts in strategies. A typical one for maybe a big box store is shifting to smaller stores so that they can move in and out of markets a little bit more flexibly. You'll see that type of shift. So I think this is a fairly significant increase, or excuse me, improvement in reporting. Another area you mentioned, James Cecil, one of my favorites. I was a bank stocks analyst for 15 years and a portfolio manager. One of the biggest areas of difficulty as being a bank analyst is the loan loss reserve for loans, okay? And this applies to all companies, not just banks. So if you read in today's paper, I think Amazon lending was written up in the paper. This would apply to Amazon lending as well. It applies to anyone who's made, in effect, or you have trade accounts receivable or loans. This standard applies. What this standard basically does is says, what did you lend? What do you expect to collect back? Book the difference. That's what this standard does. I put up here, that's the principle. Now, applying the principle, you need 3 major pieces of information. You need the historical loss information for loans that you've written over the last few years. You need the historical loss information. What did you actually lose? The green is already done today. Over the next year or two, what do you expect to lose or charge off on those loans? Where the big difference is this gray box. This standard says there's no reason to ignore what is beyond this next 2 to 3 years time period. Go ahead and make an estimate of what you expect ultimately to collect. So you're trying to fill in this loss triangle or loss matrix here to get to an overall difference between what did you lend, what do you ultimately expect to collect back. The principle here is the balance sheet should reflect the net collection that you expect to have on any type of trade receivable or loan. So it was a very controversial, but when you really break it down, this is actually going to get to be far better information for investors. And in fact, I would argue that we as investors were already making these types of estimates. Now what the standard does is actually provides you with management's best estimate of this number. And then like Todd was saying earlier, their checks and balances, the disclosures around this are incredibly strong and will actually significantly improve analyst ability to assess management skill at assessing credit risk.